Hi, and welcome back to our channel, Pay Down Debt Solutions. I'm Jen, and today I want to talk to you guys about how timing is sometimes just everything. So for those of you that don't know me, Dan and I have developed our company, Pay Down Debt Solutions, where we talk about velocity banking and we bring solutions to those of you that find yourselves payment poor, cash strapped, on the verge of bankruptcy, or in other words, basically just in debt, right? So for anybody out there who's looking to free themselves of the chains of debt, this channel is for you, okay? Whether you're in tons of debt or just a little bit of debt and want to learn a better way of getting yourself out of debt, that is what we're here teaching you, and that's what we're doing today for you. So when we talk about velocity banking, it is pretty much something that's unheard of, right? So some of you might be aware of it and might have an idea of what velocity banking is. Maybe you've heard of it. But there's many of you that don't, because we are not taught velocity banking. And how do I know this? Because I come to you as an ex-banker and an ex-branch manager. I am currently a business owner. My husband's a business owner. We develop lots of new businesses, new ideas. And so prior to this part of my life, I was a bank manager and a banker. So I learned a lot about banking tools and I understand them thoroughly. And so for many years, Dan and I didn't know how to do velocity banking. And we didn't know, number one, because banks don't teach you how to do this. And number two, because banks want your money and they want your interest, okay? They're in business just like everybody, right? They're in business too. And so banks earn their money off of interest and off of your deposits. So for a bank to teach you guys how to do velocity banking wouldn't be as beneficial to them as it is when you go ahead and you park your money into your paycheck like everybody does. You park your paycheck into the bank, into your checking account like everybody does, and into your savings account. So for whatever you have left over, you're putting that in savings. The rest of it is going out in payments, right? Because we know that Americans are cash poor for the most part. They don't have cash flow. They're payment poor. They're making lots and lots of payments because everybody wants stuff, right? Everybody wants those things out there. And to pay for those things, a lot of times we have to do that on payments. So while the banks are great, right? We need them. Let's not lie, right? We need them. We need the banks, but we don't need to be paying the amount of interest that we're paying. And so that is why we're bringing this channel to you. So those of you that don't know us very well, again, our history, Dan and I have been business owners for many years, but we found ourselves payment poor and we found ourselves on the verge of bankruptcy, or thought we needed to file bankruptcy because we didn't know a better way. We didn't know there was a better way. We didn't know one existed. And so when I tripped across velocity banking, I realized that this was our saving grace, that this would change everything for us, and it did. So no longer are we payment poor, no longer are we strapped by payments and bogged down, right, by debt. We have found a way to alleviate all of that for ourselves. And because it was so life-changing, that's why we're bringing it to you, okay? So today I want to talk to you about an interesting scenario where we have a customer of ours that, and actually it's a customer of Dan's too, because part of one of Dan's businesses is a construction company, and he works with insurance claims and works with customers. And so this customer in particular had an insurance claim that was a little bit tricky. So they had a tree branch that actually fell on their roof and damaged their roof. So they needed to get that fixed. But not only do they need to get that damaged piece fixed, they have a roof on their house that has been there a very long time, and it has a lot of issues with the roof, lots of leaks, and there's missing shingles. So really at this point, they know that they need a new roof. But insurance is only going to cover, about $6,000 worth of, patching the hole that's there. And so they're kind of in a conundrum. So they in talking to Dan, he talked to them a little bit about what we do. So they were fascinated. And so we did a sit down with them and we talked about the situation that they had. And this is what we came up with, okay? So that's what we're going to be going over in just a few minutes. But first, I want to talk to you guys about how timing can be everything, right? So you need to know what options are available to you and carefully work them out, all right? So when you have a situation like these customers, okay? So one of the problems that they have is they don't have the cash on hand to fix their roof, okay? So the insurance is going to cover $6,000, we hope, right? So we hope that that's what the insurance is going to cover, but they know they need a new roof and they have to figure out how they're going to do this. Well, they can't get a home equity loan right off the bat because they have damage to their roof. So that roof has to be repaired and fixed, and the house has to be in good order before they can get a home equity loan or line. We don't do loans, we do lines of credit. Okay, so that's part of the problem that they're sitting with. Now, they do have an option that's available to them. They don't have much cash in the bank, like hardly any, right? Because like everybody else, you know, they're making lots of payments and they spend a lot of money. They're spenders, okay? So they don't have a lot of money available to them. They do, however, have about, let's say, a little bit under 50 in a rollover that he did years ago from a company he worked for, and then he changed jobs and he rolled it over into a self-directed IRA, okay? So when we talk about a timing issue, this is what I'm talking about, okay? And so we're gonna revisit that in just a second. So you have to know what your options are and what's available to you, and you have to carefully work them out, right? So carefully work them out, because when you do something like a rollover, okay, and if you take money out of an IRA, if you're not going to take it out indefinitely, and if you do, there's all sorts of penalties and everything that comes along with that, right? You're taxed at your income tax bracket, and you're also penalized if you're under 59 and a half, and these guys are, okay? So they're in their mid-50s, so they would be penalized at for taking it out early. They'll be penalized at 10% plus their income bracket. So there's things going on here where they don't want to waste money either. So they can borrow that money basically from themselves, though, to start their roof for 60 days if they can get it in time. Now, we'll revisit what the whole timing is here. So again, the pay down 3-step strategy, they have to know what's going on, right? So if they don't know everything that's happening inside of their finances, they don't know what options are available to them, or even if they can do these strategies, right? So if they didn't know about the IRA, we'll call it a loophole, because technically that's what they say it is a loophole, so long as you get your money back within 60 days, all right? If they didn't know about that, then they wouldn't know that that's even available or an option to them, and they would have taken the money and then not realized that they could potentially put it back, all right? So with Velocity Banking and with the pay down method, we give you guys choices, right? So that's something that we talk about. Now, they have to then organize every bill that they have to make sure they know what their strategy is going to be, okay? Because they do have other debts. They do have other debts going on, so we need to figure out what's going on for them. So they organize all their debts. You have to know all the debts that you have. So the debit's going out, and you need to know what is coming in. So most people know exactly what's coming in because they have paychecks, right? They know what's coming into their account, but then they have to know exactly what's going out as well, all right? So they have to organize all their bills. The next step in the pay down 3-step strategy is to identify. They need to identify, using the velocity system, right? The velocity way, the velocity banking way, what their debt destroyer is going to be. So what line of credit are they going to use as their debt destroyer? And then they have to know what strategy they're going to be working, whether it's going to be taking the funds from somewhere, or using a home equity line, or using the loan offered to them from the roofing company. How are they going to do this, okay? So knowing those options and then coming to them, sitting down at the table and saying, what makes the most sense here? All right, so they have to know that strategy. Then the last step, obviously, is to implement their strategy, and that involves them working their strategy down, putting their plan in action, and going through with it. So you begin your strategy and you work down that debt. Okay, so here's the thing though. When you're adding debt, things can get a little bit tricky, all right? And so you need to carefully consider your finances at this point, because when you're in debt, you really shouldn't take on any other debts if you can avoid it. In this situation, it's kind of unavoidable for them, right? Because they could do the repair right now, okay? They could do that, and they could get the insurance money for that to just do the repair. But they know they have a leak, or a roof that's already leaking in spots. It's aged, it needs to be replaced. And so at this point, chances are if they get a new roof today, it's going to be less costly for them than it would be down the road, right? Because we know expenses, costs keep going up. So at that point, with materials and everything, it might be time to do it now. So maybe they have to take on this debt, okay? So as long as they know how to do and run their finances correctly, they won't get in over their heads or too far over their heads, right? Because adding another payment is that, it's adding another payment, all right? And so that gets worse, right? It compounds, and it can compound for you, especially if you don't know what your finances are. A lot of people have no idea. They take on another payment, they think they can afford it, and at the end of the day, lo and behold, they cannot. So that is something that we really sat down and worked out with them, okay? So the key to all of this is, right, carefully considering your finances and making a plan, and just knowing that you never add debt on top of debt unless you cannot avoid it. And in this case, they kind of can't, so we're going to work with it. All right, so if they use velocity banking, we know it works, okay? And I'm going to prove that to you over here at the end of the day when they look at their finances. We're going to prove that velocity banking works. Well, what is velocity banking? So velocity banking is a way to run your finances where you're freeing up cash flow that will then work down your debt for you, okay? So if you just continue to make payments upon payments upon payments, you're not freeing up cash flow for yourself, and you're not giving yourself any extra room to pay those debts down. So it will take longer. And that is what this couple would find here if they didn't run the velocity banking strategy, okay? So let's run through this. At the end of the day, the choice is going to be theirs on how they will go about working this strategy and whether or not they think that they can get a home equity loan at the time the roof is done, okay? So the roof has to be done, and they have to then apply for that home equity loan and get it before the 60 days are up. Otherwise, they forfeit the ability to put their money back into that IRA, and then they're not penalized at all, okay? So that's kind of like what we're dealing with here, where I say timing is everything. So kind of knowing how quickly the roofing company can get all this done, and that's where the debate is going to be. So that piece, they just have to figure out whether they're going to then go ahead and take that money, or if they're going to go about it another way, or take advantage of this, loan that's offered by the roofing company. And we're going to show you why that is kind of scary. But if they pay it off right away with that home equity when they eventually get it, it's not going to be too much. It won't hurt them too much, right? Okay, so our scenario is the tree damages their roof, right? We just talked about that. The tree damages the roof, then the customer needs a new roof, but insurance only covers the repair. So that's pretty common. Insurance only covers the damages from the storm that caused it, okay? So right now, this couple has an income of $5,600 a month, okay? Their total expenses are currently $4,100, which leaves them with $1,500 cash flow, which isn't a bad cash flow. That's not bad at all. But they do admit, again, that they're spenders and they do spend money, and they like to spend money. So they don't do an excellent job saving that money. They've started to save a little bit, now after they started really getting into finances and knowing that they're headed towards retirement. And so they need things to kind of come together for them. So they are starting to save money, but they haven't saved up much at this point. So they haven't accumulated too much. Okay, so their mortgage is $1,367. They're $12,112, and it's at a 6% interest rate. So again, we've got cash flow at $1,500, so they do have positive cash flow. That much is good. Mortgage amount is $1,367 monthly. They have two cars, okay, car one and car two. Car one balance is $14,690. The payment is $334. It's a 5-year loan that they're on currently, and they're about a year into this loan, okay? So they've paid a bulk down, because we know loans, and why we don't like them is because loans are front end loaded with all that interest. So you pay all of your interest. You have no choice. You pay that interest up front, and then you pay the interest first, less on the balances, and then more on the balances on the back end of that loan. So right now, it's at a 4.25%, and the interest payments that they would have paid after the 5 years will be $2,011. That's how much they're going to pay for that car loan, okay? So, and it started at like $21,000, I think is what the loan original amount was. I could be wrong on that, but they're at 14 now. So car two is $86.50, and their payment is $382. They are 5 years in. It's a 5-year loan, and they are 3 years into this loan. So, and that loan is at 3.5%. And again, after all this is said and done, they're going to be spending $1,921. All right. So then we have card one credit cards. We have 3 credit cards here. Card 1 at $4,386, $131 is their payment. 5-year payoff for this, if they go at that $131 payment, right? 27% interest rate, $3,806 is the amount they'll pay back in interest payments. Card 2, we're sitting at $8,650. We have $170 for our payment. And if they pay that at $170, it'll take them 8 years and 11 months to pay it off. And that's at a 19.75% rate. And their payback on that, so the interest that they'll pay is $9,489. We have credit card 3 here. Credit card 3 is $1,260, $35 payment on that. 4 years and 11 months on that if they let this go at $35, 21%, and they would pay $760, okay? So if we total up all of our loans here, it's $37,446, excluding the mortgage, okay? I'm not putting the mortgage into this. So $37,446. The total payments that they're spending monthly plus their mortgage payment, right, is $2,419. Now, the total interest that they will have paid with this plus this, okay, so that the 2 car loans plus the credit cards is $17,987. That's what they'll have paid in interest by the time they're done. So I've broken this down a little bit for you and separated some things out because of the strategy that we're going to run, okay? So the first thing I want to talk about is the options that they had. Again, we talked about the the IRA loophole, right, where they can take money out and they have 60 days to put it back in without penalty. And so the roof that they're going to get right now, the best estimate, it was $32,500 at 25%, okay? So this roofing company would give them a loan for the dollar amount of the roof, and they'll charge them 25% to do so, and they will be paying $953 a month. Well, look at that. This then eats into this cash flow now, doesn't it? So now they're left with like around $600, less than $600 in cash flow, okay, if they choose this option, all right? And they will have paid $24,735 in interest if they do this, okay? Again, this is a 5-year loan. Sorry, both of these are 5 years. Now, they could do a personal loan, right? They could do some kind of personal loan. I'm sorry, this would be a home equity loan instead of a personal loan. So that would be home equity. Typically, you can't get a personal loan for that dollar amount. You can find them. I mean, it's possible you can find them, but it would be a little difficult. So if this is a home equity, let's see. So home equity loan, right? If that's a home equity loan. This would be $32,500 again, and that would be at 9.25% for the home equity loan if they chose that option. All right, and that would be $680 a month, again, 5 years, and the payback on this would be $8,216 in interest, okay? So that's pretty steep too. That's another high payment. Now, the option that they really like learning about Velocity Banking, right, is to do the home equity line of credit, all right? And so they can get a home equity line of credit for $92,000 based on, 80% loan to value of their home and all that. So they can get a home equity line of credit for $92,000, and it would be at 12.25%. The conundrum at this point is the roof, the damage to the roof, and figuring out timing on how they're going to do all of this, right? So the roof should be able to be done within, really within a week. The repairs have to happen first, and then the roof would be redone, okay? So they should be able to work the strategy using their IRA monies. If they do that, then they can probably get it in on time. Now, if they're worried about timing though, if they think that there's any issue where they won't be able to get that money put back, they could do this. They could take this loan out and then just pay it off as soon as that home equity is done. So that is an option to them, right? So Velocity Banking, we're going to give you options. Pay down. We're going to give you options. So these are the 2 that we have then come up with for them. Okay, so at the end of the day, they're going to run it through a home equity line of credit. And what we're going to do is we're going to take $46,606. Okay, so where do I get that number from? Well, we know the roof is going to cost in total $32,500. 32.5. Now, we do know that we have the repair. Okay, they will give them credit for the repair. The insurance company will. So that should come back to them. And once it does, we will use those funds. But at this point, we're going to not include it in what we're doing. So we have to take the 32.5, right, plus the 14,106. So we're including the 14,106 in this. We are not going to roll it all together because the reason for this is the interest rates, they have paid the majority of their interest already on these car loans. So at this point, it would be better off for them to go ahead and pay this through, okay? They're already, a couple years in on this. They only have a few years to go, so they may as well pay that down. Now, if we were to roll it all in, you're then taking these lower interest rates that they've already paid interest on, right? The majority of the interest, I should say. And then they're extending it out and putting it at a 12% interest rate. So it just didn't make sense for them to do it that way when we ran the numbers. So we decided we were going to pay off these cards here, okay, right? So we're paying off these here, and we are going to then put it into that home equity line of credit. So we're going to start, our starting balance is going to be 46,606, so 46,606. We are then going to be able to take our entire income. And why can we take our entire income? Well, those of you that follow and understand how home equity lines of credit work, you park your paycheck into that line of credit. So you drop your interest, okay? So you drop your interest, and then you're paying all of your expenses through your checking account because they're linked to your checking account. So home equity lines of credit typically are linked to a checking account. So they will either be linked for overdraft protection, meaning that that line is connected to the overdraft, to your credit or to your checking account for an overdraft protection, and you can pay everything out of that checking account. And that should be fee-free. If it is not, then you just manually move it into the checking and pay everything that way, okay? So you can pay all of your bills this way. You don't have to hold out anything into chargeable and non-chargeable because home equity lines of credit, you can pay everything through it. And that's what they're going to do. So we put our income in, right? So we park our income right into that home equity line. So you put it into the checking account, you direct deposit into your checking account, you make a payment then down of $5,600 to that line of credit. So you drops your balance to 41,006, okay? So we go from 46 to 41,6. And that is what makes Velocity Banking so beautiful, because it is calculated on an average daily balance. It is not front-end loaded. You don't pay all that interest up front. You pay it monthly as an average, okay? So the credit card company or the bank or whatever line you're using, they're going to average that daily for you. So we get an average here. We take our high balance plus our low balance, okay? Because we need an interest rate. We need an interest percentage here. So we take our high, we take our low, we add it together, we divide it by 2. We take that number and we're going to multiply it by our interest rate, which is going to be 0.1225, okay? And then we're going to get 12 months of interest for that line of credit at that amount, okay? So we don't want the 12 months though, we want 1 month. So we're then gonna divide that number by 12. So each month we're gonna do this and divide it by 12 because we want that month's worth of interest because we're dropping our balance as we go along, right? So you have your expenses, which are all in blue here. Our expenses come in and they're in blue. So our expenses come out. Our interest, well, we should say our expenses come back in, right? Because we're going to be charging those throughout the month. And our interest has to come in. So we figured our interest was at $447, okay? So $447 is going to be the interest for that month. So our balance now is back at $45,553, but it's dropped from the $46,606. Now, then our income comes back in at $5,600, and it drops our balance to $39,953. Again, we're going to do our average, divide by 2, take that number, multiply it by 0.1225, and it gives us our 12 months. We divide that by 12 to give us our 1 month, and that's where we get the 436. So we've gone from 447 to 436, and so our balance then, after all these come back in, is $44,489. We are going to then carry this out for how many months? 33 months. So it takes 33 months to take care of $46,606 in debt, okay? So it takes 33 months, which is, it's 2.75 years, okay? And and so what do we pay? So for just this part, okay, we're going to pay $8,414. So for the 46,606, we pay $8,414 in interest. But we can't forget, we have to add in the interest from our cars, right? Because we left those out. So we give 8,000 plus the 3932 gives us $12,346 to handle the debts. All of the debts at this point are gone by the time we get to our 2.75 years. Actually, we have, this will be left a little bit of time on that left, right? Because we were a year in or so. It takes us 33 months, so we'll be pretty close. But so for our entire debts, we're going to have paid $12,346 versus had we let it go, our total interest would have been $17,987 for all of it, okay? So we saved overall by running it the Velocity Banking way. Now, had we left it with the roofing company, okay, and not done Velocity Banking, and had we left it with home equity as a home equity loan instead, this is what our numbers would have looked like, okay? So if we didn't do Velocity Banking and we did our, I don't know, I put personal on, sorry, so sorry guys, this should be a home equity loan here. Okay, so if we did the home equity, right? Okay, so we'll say HE loan. So if we did the HE loan, if we did it the home equity loan way, we would have spent $26,203 in interest, okay? Significant difference from 12 now, isn't it? So it would have cost us $26,203 because we had the total amount here plus the $82.16 from the loan itself. Okay, so you add those two together and you're going to get $26,203. Now, if we left it with that roofing company, it would have been $42,722. That's pretty steep when you think about it, right? So there's no way they're going to do this at the end of the day, knowing what they know now and knowing that they can use Velocity Banking to get themselves out of debt. So in conclusion, the best thing for them is to run their finances through Velocity Banking. I know it, you know it. It will save you guys so much time, effort, and energy. And take a look at the numbers, work them out for yourselves, and hopefully you've learned something today. I will see you in the next video. Have a good one.